So, what are the components of financial due diligence? So, financial due diligence is, as we look on a typical due diligence timeline, for those actively searching and, for the one individual who is under LOI, typically you purchase a business over the course of 60, 90, or 120 days. Over those number of days, certain milestones and projects are commenced. So you'll commence a financial due diligence project. You may kick off your bank and underwriting process through the SBA or a traditional lender. Um, then you will engage things such as tax due diligence, understanding what the tax statements look like, if there's any tax compliance issues, state, local, and federal tax, and then you'll kick off legal due diligence, which is typically conducted by an M&A attorney. All of these components lead you to your final closing document phase or the purchase, the PPA phase, which is the negotiation and ultimately the signature of the purchase price agreement, which after that's signed, effectively ownership changes hands from the old seller to you, the new prospective buyer. So I think it's important to understand where you fit in this process. And when you do go under LOI, what does that look like in terms of like a number of days to get you from the point where you sign the LOI all the way through to finalizing that business purchase? So, in terms of, I'm just kind of curious, why do you think deals often fall apart? So, like, what is the most common reason you think deals fall apart in the last week before closing? Would it be things like around financing issues, uh, disagreement over working capital, the seller backing out or changing deal terms, a little bit of both, all the above? Curious where you think most deals fall apart. So we had a good group, a good mixed response. The correct answer I've seen is all of the above, but things like last minute financing issues, disagreements around working capital, those happen frequently. Sellers backing out or getting cold feet. Unfortunately, I've seen a few in practice, but all are very real reasons why these deals fall apart. Uh, it is, for those actively searching, unfortunately, deals falling apart is a nature of, an unfortunate piece of buying a business. It is a marathon, not a sprint. But hopefully, if you follow the correct steps and you know, buy good businesses from good sellers, you can limit and mitigate broken deals to the extent possible. So, since we have an understanding of what the timeline looks like, let's dig into the components of financial due diligence. So, financial due diligence, if we think about the map, is typically commenced once you have a signed LOI. And the reason why you commence financial diligence right away is you need to verify the earnings and net incomes, the revenues, expenses, and net incomes presented to you in the SIM, which you use to submit an LOI, are verified. So how do we actually do that? We do this through really it's like a five bucket component process, which is the financial statement analysis, which is a detailed review of the granular general ledger data of the profit and loss statement. Things like the revenue accounts, the expense accounts, and ultimately what those components look like to comprise net income. You're then going to conduct a working capital evaluation. Working capital is looking at the current assets less the current liabilities, and then removing things like cash and debt. I hold separate webinars specifically on working capital because it's quite comprehensive. So feel free to check out, my YouTube channel. I've done a few deep dives already. If you have questions about what that looks like. Uh, the final three pieces are the tax compliance and risk review, which happens in tax due diligence. Proof of cash is leveraging the bank statements to prove out reported revenues. I also go into a deep dive on a separate webinar about that topic. And then lastly, the quality of earnings Q of E review is effectively the EBITDA analysis. So the Q of E review and the financial statement analysis go hand in hand, um, because the findings you'll uncover when you conduct a proper financial statement analysis lead into what does EBITDA look like, whether it's adjusted upward or downward based on some of your findings. So those are really the big components of what financial due diligence looks like. So I think it's important to understand like a framework uh, when you even start this process, or if you have questions about what is financial due diligence even comprised of, I would point back to this slide deck as a good bucket of categories of some of the components. So, what are the benefits of doing effective diligence? Really, it's to set the foundation for a successful acquisition. Um, if you're able to verify the incomes of the business you're about to buy, you can arm yourself with the confidence that this business can support bank debt. In this interest rate environment, it's quite expensive on a monthly basis, given where interest rates are currently, to pay down, the monthly debt payments. So being confident in what the earnings look like on a month-to-month basis is vital to your acquisition success. By understanding what net income looks like, you're ensuring a fair valuation is being placed on the business. For example, if you're under the impression that a business generates $1 million in net income, um, after conducting financial due diligence, it turns out there were certain items that reduced this net income to about 600,000, things like a revenue adjustment or an error in recording revenue, which was later removed, etc. Those things decrease the overall earnings picture of what the business looks like. Um, why it's important is you typically will place a valuation on what does the earnings look like, for example, $1 million, dollars, and then you'll use a market multiple of three, four, five, or six times earnings applied to the given valuation. So for every dollar of adjustment you make to the earnings of the given statements, you almost get a 3-to-1 or 5-to-1 basis for each dollar. So these are real dollars at play. And I'll kind of walk through an example of what that looks like in a little bit. Um, and really, the reason why you conduct due diligence and some of the levers you can pull is this is to build trust between the buyer and seller. And I say that because I'm often asked, why conduct financial diligence? Um, I can do it myself. And the answer is yes. You can use some of the teachings on this webinar or through my other trainings to conduct diligence yourself. The challenge is when you do uncover something that may materially alter the valuation, are you comfortable articulating this yourself? Or would you rather have that third party buffer to maintain your relationship with the seller? You're As a new prospective buyer, you're going to need the seller in your corner to ensure rapport with the employee base, etc. So if you damage your relationship with the seller by asking difficult questions, which you need to ask, what is that going to cost you? Um, that's often the question you need to ask yourself if you're kind of thinking about, well, whether I'm not sure if I should engage a financial diligence provider. That's one of the benefits. The other benefit is By engaging that third party, you get an unbiased view of the business with a partner that does not have an equity stake. The reason why equity is challenging, especially for acquisition entrepreneurs and even independent sponsors, is you've spent a lot of time and effort in this deal. You may really like this deal for a number of reasons, which rightfully so is excellent. Like you should love the business, um, love have a good relationship with the seller because ultimately this might be your new day job going forward or part of a larger holdco strategy. So getting this acquisition right is vital. Um, so by conducting effective due diligence, hiring the right legal team, you set yourself up and create a foundation for a successful acquisition. Um, unfortunately, I've seen often when deals go sideways, it's due to the deal team being assembled late at the last minute, um, or prospective buyers trying to cut corners and conduct these things on their own, and then ultimately buying a business which has a very different profitability view than what they anticipated. So let's do an income statement deep dive. So picture this. You are, you request a SIM or a monthly financial statement for a prospective business. Uh, you're provided what looks like a monthly income statement. It has various income accounts, expense accounts, etc. Now, what are you looking to do? What's the point? Why should you be doing this? So ultimately, you want to understand and verify a few things. You want to verify the overall profitability of the business. So if the business in the SIM or marketing materials showed $1 million in net income, you want to run the accounting records in QuickBooks, NetSuite, or another accounting system to verify that the line item shown in the slide deck or fancy marketing materials is real based on the granular components of of the income statement. So let's take a look at something in practice. So this is a sanitized report of a recent deal conducted several months ago. So you'll see at the highest level, this is what an income statement looks like. So a couple items to make note of. And I'll try to do my best to zoom in on this just a little bit. I'm going to stop share and reshare so I can get this a little bit bigger. Okay. Alrighty. Um, yep, so that looks a lot better. So let's unpack what we're looking at. So, going back to our example, picture this. You've requested the monthly income statements for a business. So what does that look like in reality? You're going to have things such as expenses. Um, you're going to have components of income. So for this one, it was subscription revenues, professional service revenues, etc. Um, you're going to have things such as, operating expenses. So you're going to have sales, payroll expenses, etc. So all of these individual line items comprise what are the components of expenses. Oftentimes, when you're submitting a bid or in the pre-LOI phase, you're given totals. You're given the total line item of here's operating expenses, here is what net income looks like. Um, Here is total income. But you don't understand like what all of those line items are made up of dozens or hundreds of individual general ledger accounts. And this is where you need a trained accountant or CPA to comb through this report on a line by line basis to check for cracks in the story. So what do I mean by that? Uh, when I'm given a P&L, I immediately will look for a few things. So I start at the gross margin level and the net margin level. So if we look on the line item highlighted here, the net ordinary income margin fluctuates from 25% in 21, 9% in 22, 12% in 23, and then 29% in January through November 24. So when I look at this, a few questions pop into my head. The first is, it looks like the business is performing much better. 29% margin is substantially better than 2023. So my question to the owners would be, what changed to cause more profitability? You'll see that they've they only had net ordinary income of about 200,000 in 2023. Then all of a sudden they're showing 500K of 2024 ordinary income earnings. That's a significant pickup. Um, the reasons why some of these things happened are, if you look at um, some of the operating expenses, they seem relatively flat, million, 1.1, and then about a million. But as a percentage of total revenue, these operating expenses have actually declined. So the operating expenses are not keeping pace with the revenues, which are largely unchanged year over year. So starting at the margin level is typically what I will do when I'm first given a P&L. Um, the point of an income statement analysis is to do a line by line review of the accounts to understand how are these accounts being recorded, um, ask questions about why things went up or why things went down, um, to begin having that conversation with management, to ensure you are equipped with the information to verify how they're recording it is correct and reasonable. Um, Another example, it will be, as you're doing this line by line general ledger income statement analysis, you can ask questions and learn about the operations. So, for example, the sales payroll tax is something I highlighted. You'll see that it went from 75,000 to 238,000 year over year. So I would ask a question, for example, why did that go up? Um, and in this instance, it was due to hiring new sales staff. So that's an important operational nugget you should know when you're going into buying a business. So these two, in this instance, it was two new sales staff who were recently brought on, which was hopefully going to lead to more growth. As a prospective buyer, doing an income statement walkthrough, a P&L walkthrough, as I call it, can be very operational if you know how to ask the right questions. Um, by starting with the numbers, for example, you can learn about the company's new hires. So it's almost, so when I do an income statement review, I use it to understand what the numbers are, but then I also will ask the seller questions around the operational components to get both sides of the equation. If we keep ticking through, um, you will notice the net incomes again, went from 25% to 9%, 14%, and then 29%. So the question you have to ask yourself is, if we look at in historical average, the business was averaging about 210,000 each period. All of a sudden, starting in 23, and it looks like in 24, they're on pace to do record revenue, record gross revenues, year over year. So those are great businesses to buy because it looks like the business is starting off. You're walking into a business that's performing its best it's ever have. The challenge is that growth sustainable? So you need to understand what are they doing, uh, which caused this increase in subscriptions revenue. You'll see that it was 1.1 million in 2022. Now it's trending to 1.46 in 23, and across 11 months, they're already at 1.5. Very likely they could get to 1.6 or 1.7 in 24. So asking these questions, the owners could be, well, we want a new customer, we raised our prices, etc. The point of the income statement review is to begin asking these specific questions which are moving the needle because you're paying a valuation likely, uh, maybe it's based on the 24 projections. Maybe it's based on an average. Um, Depending on the deal and how the broker is listing it, um, you need to understand historical performance of the business. What is the business trending towards? And conducting this sort of line by line income statement is a great place to start. I've been doing financial due diligence for over a decade, and I like to do this detailed income statement review very early on in the process because A, it begins to poke holes in the narrative of the business, and B, you get a much better view of what operations look like um, on a granular basis, really in the early part of due diligence. The sooner you can begin this during your LOI, the better, because findings in due diligence may adjust your purchase price. If, for example, uh, there were certain items discovered which materially impacted the valuation, you may need to go back to the drawing board and try to retrade for a lower purchase price based on the adjusted earnings. Uh, so these are some of the components of how to conduct an income statement review specifically for this deal. This is very accounting driven. So if you don't have an accounting background, if you're not comfortable running a general ledger or reading an income statement, I would encourage bringing on, someone with a trained eye, a licensed CPA, or someone very familiar with an income statement uh, review, because these small businesses can have funky accounting processes. They might not have the cleanest books. But at the bare minimum, you need to conduct an analysis like this because otherwise you're buying a business with unverified earnings. So, you know, we touched upon margins, which I love to start with because it does quickly show changes on a month-to-month basis. So we talked about net profit. The EBITDA margin is just a function of your reported EBITDA, and then gross profit, or the gross margin is really your revenues less your direct costs. So that's the primary components of the income statement analysis and how I typically will conduct them. Uh, Depending on the type of business you're buying, uh, you can every income statement will look a little bit different. But I think starting with, where are you in your deal process? If you're under LOI or anticipating an LOI, what do I need to do, on days 1 through 30? It is to begin financial due diligence and perform this P&L walkthrough to verify the net incomes presented in the SIM, which you use to submit an LOI, is largely verified. Because until you do that part, it doesn't make sense to start tax, legal, or even the purchase price, the draft, because you might be buying a completely different business than what you thought you were. So I've thrown a lot of information out. If you have any questions, continue to throw them into the chat, and I will get to them in just a few minutes. So here is a free copy of my financial due diligence checklist. This checklist is about a 10-point document which highlights all the things and data you'll need to conduct financial diligence. I use this on all of my deals. I've done hundreds of deals. It's a very clean, concise document, so feel free to scan the QR code to receive a copy. As we kind of touched upon, this is a snapshot of that workbook we just looked at. So again, the point of the income statement analysis is asking for those granular monthly financial statements. In this instance, it was over a 4-year period. It was 21, 22, 23, and then January through November of 2024. You want to line them up in a single Excel sheet and then begin that line by line or row by row analysis uh, of the granular general ledger components of a given income statement. From there, it's important to verify, a couple quick things. Looking at net income as presented in the generated accounting reports compared to what the SIM looked like. If there are material differences, you need to ask the broker or the seller those questions right away. It could be a function that the broker had limited information or was using an assumption-based approach when they compiled their document. Whatever the reason might be, um, it's not really relevant what the SIM is showing in terms of net income. Your valuation and what you pay for a business should be grounded specifically in the accounting records of the business you're looking to buy. If you're buying a business based on projections or go forward assumptions created by bankers or brokers, you're setting yourself up for the risk of buying a business that is based on projections and hopes and not realities. So that's the first thing you should do when you do start due diligence. If you're conducting this yourself or if you're bringing in a third party, make sure they start this income statement review right away. Here is another way to cut financial statement analysis by looking at the year over year trends. This was for a different deal. I like to plot out historical year over year changes and show, these arrows for quick indicators. So you'll see from uh, 20, 2021 to 2022, the total expenses decreased about 22%. If you take into account the total income, income only dropped by 8%. So what's going on here? And this is just a guess. It's possible the business had a lost customer, which led to the 8% decrease. It's also possible that the business is experiencing pricing pressure due to increased cost of goods sold, increased labor costs, and they're not able to pass along those costs to the current customer base. In a typical environment, your income and your expense would correlate, based on your level of margin. When there are large swings in income or costs, it's good to double click and understand what happened. It's likely a combination of a few different things, but plotting out these historical year-over-year changes is a great first place to start because it'll flag things that are important. Um, Additionally, if we zoom in further, the business increased 4.5% of total income year over year. That's great. The business maybe increased pricing, maybe they won a customer, they lost one, and the net was 4%. But if we look at the total expenses, a different picture is painted. So now the business has 28% higher expenses year over year. So their expense pool was 970 and now it's 1.2 million. Um, this also, this line item is really operating expenses. You'll see the total cost of goods sold is a different line item. That is relatively flat year over year. So this total expenses is operating expenses. It could be salaries, it could be rents, marketing, advertising. So just expanding that and understanding what happened is important. On a net income basis, really this is where your valuation is going to be based on. If you're basing it on net income or EBITDA or the SDE, likely this last line item is what you're going to be buying a business on. Uh, if you see here, the business was trending quite nicely in 21, but has significantly declined into 24. We sit here today in August 2025. Some of the things I'm seeing in practice are businesses that have been on the market for several years may only have financial data up until halfway through 24. Um, some of them largely are open because of the tax filing. So making sure you have clear data and the latest data is super important. Uh, if, for example, this business was on the market in 21 and you were sitting there in 24, without this 24 information, you're buying a completely different business today than you were a few years ago. Brokers and bankers who have had these listings for several years may not adjust the valuation appropriately based on what the looks like today. So just keep that in mind. Overall, the point of this is when you're asking for financial data, make sure it's the latest copy and the most recent. Push back if there's comments like, "Oh, it's not available," etc. I would ask, even if it's not verified, I'd still like to see how the business is trending because it's important to know.